Good morning, everyone. Or good afternoon, I should say, as we just switched 12. I've been really looking forward to this panel all week, and I know many of you have asked me questions about where are alternatives going, how's the cycle impacting, do we see cockroaches, what about continuation funds? There's a huge number of questions that we should get into, and I'm thrilled we've got a great panel from across the ecosystem, Pascal, Debbie, Boza and Tony, who have got perspectives across many different asset classes. So look, the question we were teed up with was like the best times behind us. So in a way, maybe I'll start, Boza, with you of where do you see the best opportunities for the next 5 years, and where are you most worried?
Simple
Easy
question.
one. Let's start easy.
So let's meet you also. Both Adeghe from the team at Coller Capital, private equity secondaries investor. And so look, I think it always depends on your objectives as a program and what you're looking to achieve. I'll give a very unbiased view that I have, which is that opportunities which kind of allow for diversification in an environment where we don't know what challenges the next year is going to bring, have some value. And clearly you can build a diversified portfolio across a lot of different asset classes, be it equity or credit. Our lens as a secondaries investor is to build diversified portfolios across both and to kind of come into those opportunities at a point where there's visibility on how underlying assets are performing. So look, as a strategy, this is one that we see as being really interesting at this point in time. And even in prior periods where market environment has been different. But as always, it really depends on your program and what you're looking to achieve.
And before I pass Pascal, concerns, what's the number one area that you're debating on your investment committees?
Every year the specific risk that comes into focus changes. Look, I think we spend a lot of time thinking about asset duration as it relates to opportunities and portfolios that we're underwriting, and just a world in which when I joined Coller in 2012, we think, hey, this is an asset, it's been bought, it's going to be sold by a sponsor in 5 years. That is not the world that we're in today. So we spend a lot of time thinking about what is the right duration, whether it's a portfolio of credits that you're underwriting or a portfolio of equity. Clearly, I think the macro and other issues we'll be talking about next year will be very different than anything that we know of right now. So don't have a crystal ball there, but asset duration is a big thing, a focus for our own committee day to day.
Thank you, Boza. Pascal.
So I can't claim any expertise whatsoever on anything other than what I do, which is private equity. So I'm going to go unbiased and as well, and try to zoom in a little bit within private equity, where we see the best opportunities in the ecosystem, is where we think sponsors, financial sponsors, asset owners can actually create operational performance within companies and make them better companies than whatever they bought 4 or 5 years prior. And we think that particularly in this segment, the mid-market is where we have seen, where we are most emphatically, I would say, opportunistic or optimistic about the right sponsor's ability to create value. And what I mean by the right sponsors here is those who have operational industrial expertise within the type of assets that they buy, right? So if you marry companies good companies that can do with a little bit of work here and there, and sponsors, asset owners who can do that work and have the operational expertise to pursue value creation in the right fashion, that's what gets us most excited. Conversely, our investment committee is a little bit more worried these days about perhaps the very large end of buyout markets. We come from a couple of years, 2 or 3 years of relatively low liquidity compared to historic standards, right? There's been far and fewer exits in private markets, and we've seen that particularly pronounced at the very large end of the market.
Thank you, Pascal. Deb.
Thank you. Just to reiterate the comment, obviously, first and foremost, for us, it's kind of engaging with the client, asking what their objectives are, both for their private markets portfolio. So is that kind of capital appreciation? Is that income? Is it inflation protection? But then also at the total portfolio level as well, understanding what the objectives are and then constructing a portfolio based on that. So if we look today, maybe given that we've covered a couple of asset classes, I'll focus on ones we haven't covered. In the private debt side of things, look, direct lending, particularly on the US side of things, spreads are looking a little bit tight. We're focusing, I guess, more on areas where there is that relative lack of capital, important word, relative lack of capital. And for us, that's leaning into more, I guess, kind of specialised strategies, so like asset-based lending, specialty finance. And the reason being is that we think kind of the relative lack of capital here, the lower level of competition, but also the complexity premia that we're able to get through there will create what we hope to believe kind of attractive spreads with potential for upside as well. I completely agree, just quickly on the secondaries, but also co-investment side of things. Again, when we're thinking about talking to clients about allocating to the asset class, if it's a brand new client, there could be obviously a desire for faster deployment of capital, for mitigation of J-curve. Co-invest secondaries can help with all of that. And then maybe quickly on real assets. Look, I think real estate's been an area that has struggled, but we're potentially at the bottoming of the valuation cycle there, particularly for maybe core and core plus real estate, so potentially an opportunity to buy. And then on the infrastructure side of things, look, it's been a really strong run for critical infrastructure. We remain kind of attractive on that. And if we look at, I guess, some of the mega trends coming through or continuing to come through, in terms of like AI, digitalization, aging population, transport, energy transition, the list is endless. But I think for us, kind of look, this is top down. I think it's also really important to look at it from a bottom up standpoint as well. And by that, kind of for us, that's certainly manager selection. You can have a sector that's challenged, but you can have an exceptional GP. And for us, it's making sure that you're balancing that kind of top down opportunity set with making sure that your bottom up is also right in terms of manager selection, because we know the dispersion between top quartile and bottom quartile is huge.
Yeah. Tony?
I'll also go on the unbiased bit. So Gresham House is one of the largest natural capital managers in the world, and also in Europe in energy transition. So if I try to pull away from that a bit, I think where capital flows are going in terms of asset allocation is clearly supply and demand, where you want to kind of place your investment bets. Private assets, you need to have a long-term investment horizon, and you need to judge things over that. And I do hope, particularly consultants, recognise that quarterly appreciation is something that long-term private asset market managers are not focused on, and that's important because when you make an allocation, when you take forestry, where we're the 7th largest in the world, you make an allocation for 20 years. You can do it for 10, 15, but the reality is you should be thinking that sort of length of time, and your liabilities are, that you're trying to match are that length of time. The capital flowing into those areas of new private markets is the point I was making. It is on everyone's agenda. How they get, if you go back 25 years, private equity allocation was zero. Jeremy Coller raised his first fund in the late 90s, $5 million, I think it was, and I was sort of I was around at the time. And it's now at 10 billion plus, I think, whatever his latest funds are. And that's important because the allocation of private equity is now normal. 5-10% allocation is pretty normal, and then you go back 10-15 years, infrastructure was zero, it's now 3.5, 3.7, discuss. And these new areas of private market, the capital flows into them over the next 10 years will be considerable. They are becoming more normalised. Things like natural capital is now asset allocation, certainly in the LGPS area. It's gone from, you talk to some of the pools, they have gone from 0 to a number, 4 or 5 actually. That's a considerable amount of capital, and I've been around the world in Australia a few times this year, Japan, Canada, and there's still a big move to private markets in areas like energy transition, like natural capital. So the point, come to the answer here, is that capital flow, there's going to be demand for these things, yet there's still inefficiencies in those areas. And the inefficiencies will drive ultimately the values and then the ultimate return. So you can buy well in the inefficient areas because the capital isn't totally there yet at all. And then you've got the demand pull from the capital that's going to flow there over the next 10 years.
Perfect. Brilliant. Well, look, I'm going to bounce around a few things, and obviously I'll come to the audience for questions in a moment. Maybe, Bosa, can I pick up on duration? So what I'm intrigued by is that a lot of the entrepreneurial flair of the last few years is finding solutions to duration, so secondary funds, PIC, NAV financing, and so forth. Also, an increasing number of family offices are coming in and saying, "I'll just buy the whole thing forever." Where do you Where do you see the most growth, or if the IPO and M&A markets pick up next year, is this just a cyclical phenomenon?
Yeah. So maybe on the continuation vehicle theme, I guess that thesis that you have managers who want to hold assets for indefinite periods. I think it's from a manager perspective, it clearly makes a lot of sense. One of the hardest things to go do as a sponsor is go find an asset that you have conviction in, that you think has a good go-forward story. If you happen to own one of those already, and you are XYZ manager, you're KKR, does it make sense to sell that to Apollo, to Blackstone, to hand it off to someone else? So, rather than go search for a new asset, why not keep the asset that you have? It feels like a no-brainer to a degree, and clearly there's the need to think about all the stakeholders involved. It's not all about the GP. It is ultimately about the LP. So the appropriate thought needs to be given to the governance around that. But the proposition for the GP is compelling. And so I think even in a world with greater M&A volumes, even in a world with greater IPO volumes, that mix of continuation vehicle, other exit paths will change over time. But in absolute number, it's hard to see that going away, the continuation vehicle construct going away as a solution.
And so, Deb, as you're advising asset owners, are you getting much pushback on continuation vehicles? Is it what do they do if they're faced with this?
Yeah, I think it's a great question, and I would agree with everything that's been said, particularly in terms of, look, it's not just beneficial to the LP, it's also beneficial to the GP, and that's kind of a very similar view in the fact that we will think it will remain over time, and the percentage of the exit market it represents will vary as we see kind of IPOs hopefully and M&A pick back up. Look, I think there are naturally questions from investors, particularly around conflicts, how we're pricing these assets, all fair questions, all valid questions. I think for us it's just another demonstration of kind of the evolution of the market, and we're making sure again that the right due diligence is being conducted on the continuation vehicles, for example, and there's other things as well being looked at too for liquidity solutions. NAV financing has become a hugely popular area as well, and again making sure that I guess the reason they're doing it is the right reason, and for us digging into that, doing our due diligence and standing behind that. So very valid questions from investors coming up, but I guess on balance, it's understood as a additive to the industry.
Okay. Tony, can I ask you a slightly different tack? So you're obviously one of the leaders in natural capital, but around the world there's a bit of green hushing. You can't mention the word ESG in the States without being pushed out of the room. How are you changing your pitch? When people are buying your funds, are they putting in infrastructure? How does this work?
So many questions there.
Sorry.
Well, it depends where you go.
Well, yeah.
I mean, the green hushing. Well, basically, if you focus, and I've got my chaps always to focus on making money. Clients primarily all the way through, despite all of the push on ESG and sustainability, you had to make money, and maybe that got subsumed and shadowed, but the reality is that's coming through now, and that's really important. So as long as it fits in a portfolio, adds portfolio characteristics that are additional, and makes the right amount of return, you then go to the additionality around carbon sequestration, etc., etc. And that is primary. And I think what's good about it, you call it hushing, is the fact people are going, actually, this is what I have to focus on. That's great, because our guys make money, which is excellent. When you go around the world, people do have problems with benchmark. If you go to the US, Australia, they have this YFYS thing. Okay, and they have this benchmark, and suddenly natural capital, they know where to put it. They put it into infrastructure, and it doesn't work on the old characteristics and factored analysis. Versus infrastructure, suddenly it's like zero allocation. Fortunately, we found some Aussie supers that are thinking outside the box, not dominated by YFYS, your fund, your future, and they're allocating, which is great. But this is a real problem, and consultants are, they're an important part of this, because they need to say, listen, where does it fit in the portfolio, not regimented around box ticking. When you come to other aspects of the portfolio hushing, when I've been in Canada recently and America, those blue states that were already allocating to this area will still continue to allocate. They have done that, they are doing that. And Canada is doing its own thing, and it's well ahead of allocations to this space, and including infra and related activities and natural capital, agriculture. Agriculture is coming on the agenda, actually, and for people, despite the tough returns because food security and such like. So, long story short, make the right returns. Highlight the fact that it adds to your portfolio in terms of all the inflation linkage diversification. Make sure you report the additionality characteristics, sustainability characteristics, and when you go around the globe, be careful around benchmarking. But that then can create the opportunity because some people are forced sellers and forced buyers, and that's dislocation is the value opportunity as well.
And just one follow-up in terms of forestry versus agricultural land. Where's the real focus at the moment for investors?
Those people that are au fait or have allocated take a step back. It takes about, in our experience, 3 years to educate an investor in a new asset class like this. So the push 5, 6, 7 years ago around green meant people go, I want to do this. And then they went, oh, actually, of course, it's quite complex. Let's think about how do you make money out of trees? How do you make money out of land? And it's quite simple at the end of the day, but they take a bit of time. We estimate 2 to 3 years it comes of education and research to do that. But when they get there, they then feel they can continue to allocate to that. What people have typically done when it comes to natural capital, which, as I say, has gone from 0 to 4 or 5% in, I mean, I should defer here, but I'm aware some of the pools have done that, and up to 5%. Is they've gone, that's quite complex, haven't done ag, that's very complex, and biodiversity, very complex. Forestry's got a 20-year track record, and that's interesting. I can do that because I feel as though I can safely put that in my portfolio as the first step on the journey.
Perfect. I remember one of your competitors trying to pitch to me that the great thing about forestry is trees grow every year.
They do.
So,
4 or 5%, Q.
Yeah, exactly, I remember that. Pascal, has sustainability disappeared off your radar?
Absolutely not. Absolutely not. It's a key topic. We are acutely aware that it is central to many of our investors' mindsets. And so, look, I mean, there are managers who are opportunistic about the topic of sustainability, and so buy companies with the idea of let's not mess it up and let's see what we can do at the margin. And there are others who are not even necessarily impact managers who are very intentional about sustainability driving pretty much everything they do across every asset class. If you think, I mean, no-name basis, but if you think some of the larger firms out there who have managed multiple asset classes between buyouts to infrastructure to real estate to growth and you name it, they have centralized sustainability agendas across everything they do. And we very much look to them to inspire the broader investor community and pursue these goals. I will tell you something, whenever we underwrite an investment, be it into a fund or into a company or the likes, our ESG team gets completely integrated into the underwriting of the whole investment and ranks a manager or a company across a number of really key criteria that we have in mind.
Perfect. Anything either of you want to add? Otherwise, I'll ships. So I was asked to ask about cockroaches this morning, and more broadly the credit cycle and where are we in it. Deb, I'm going to pick on you first, if I may, because obviously you speak to a lot of managers. What's your perspective on the credit cycle? How worried are you as an allocator to private credit for next year?
Yeah, obviously headlines have been very active. We've had a lot of clients reach out asking questions, and all fair questions, right? It's something we are thinking about constantly. And for us, I guess maybe the more recent events, we wouldn't classify them as kind of systemic. We think they're much more idiosyncratic in nature, driven by obviously certain situations. So that for us isn't kind of necessarily a catalyst for everything to crumble away. And I think, to be fair, it was said in the panel prior, though, but we have to be aware that we haven't really seen a troubling market for a number of private credit managers. Like, if we go back to kind of GFC, but a number of them weren't around there. So, like, it is, particularly in our due diligence and our underwriting, it is an area that we are probing. We need to make sure that they are maintaining standards regarding kind of covenants and kind of their underwriting, because, look, what we do know is something will happen at some point. It may not be tomorrow, it may not be the day after, but it will happen. So kind of making sure that we've got that comfort in the underwriting quality of the managers that we're selecting is of the utmost importance to us.
Boza, what's your take on this? I mean, should we read this as being a real loosening of underwriting standards, and that's what that's the feedback we're getting? Well, how do you?
So I think what may be forgotten from time to time is the fact that people underwrite, or certainly we underwrite, a portfolio of credit funds with many underlying companies with an expectation that there will be issues. So the key there's maybe sort of need to understand how is what we're seeing in certain instances that we're doing in the press, how does that tally with what people actually expected on day one? Because we go into a portfolio, not just us, I'm sure most credit managers do go into a portfolio expecting some level of default, expecting some level of recovery on default. And so the question is, are defaults and recoveries running at levels that are way different than original expectations? And if they're kind of in line with what people expected from a diversified portfolio, then in reality there is no systematic issue, to be honest. I think for us, in the rate environment that we have been in, had a view that maybe defaults may have been here. In reality, they've been here. So maybe there's some degree of catch up to what we might have expected a few years ago. But look, there is risk in credit, there's risk in equity. So the key question for the headlines is what we're seeing materially different from what everyone expected on day one when they did their underwriting? And I suspect, what we've seen in terms of realized defaults is probably below what many actually underwrote on day one.
I think that's true. And maybe just something to add as well, as you were talking, and think of it like, look, with what we say to our clients, particularly in investing in private credit, is you win by not losing. And essentially what we mean by that is, look, you want to be diversified as possible within your portfolios. You want to make sure you're allocating to multiple managers with multiple different strategies with kind of hundreds of loans underpinning that. So if we will see defaults, like that's just a fact of the market, but that one of those defaults won't completely knock out all of the upside.
I mean, it was very striking that one of the funds, actually it was a hedge fund rather than a private credit fund, had 35% of their fund in first brands. Like, guys, what are you doing? Pascal, sorry. Oh, sorry, I'll come to Tony. But Pascal, Tony.
I was going to say, a wise person once said to me that they had predicted 10 of the last 3 recessions.
An economist friend of yours.
Exactly. And I think it's key to understand. I agree with everything that's been said. It's key to understand that a real default cycle has not taken place since the GFC, really, because COVID wasn't it. No. But despite that, if you go and look at every credit manager's portfolio and performance and how they generate, let's say every credit manager's aiming to deliver, pick a number, 8, 9, 10% to their investors. There's a very fundamental difference between delivering that by charging 9 or 10% to every company and never losing your capital, as opposed to charging 15% to your companies because they need you as a lender because no one else is there, because there's something going on, knowing that you're going to be losing capital every now and then. And if you look at actually scrub under the surface, it's true that defaults haven't happened, really. But if you look at the underlying loss ratios or default ratios and recovery of each manager, there's very pronounced differences between them. So it's a question of, do you get to that 9% by sleeping well at night, i.e. by not losing, or do you get there by being a little bit more adventurous on who you lend to and how you charge?
Well, when you look back in time in history, whether it's a GFC or Asian crisis, when systemic risk was almost started again in the 90s, you never know. You know that you don't know what's going to catalyse this. But what you do know is when you have lunch with someone and you talk to them and they go, I've just raised a fund, it's a credit fund, and I can raise a NAV line against my credit fund. And suddenly you've got lending against lending against lending, which people don't think about. And that is only when it catalysed, when something happens. And you just don't know, but we do know the amount of credit in the system and the benign environment, including COVID. Because when COVID came along, we've now seen government debt go to, across the Western world, what it is, because they bailed the system out.
But it's interesting on that, Tony, that the Office for Financial Research, so the US version of the FPC, a research body, is actually about to publish something on fund finance because they've asked that question, and the Bank of England thing announced this week is going to do the same next year. So I think you will get a bit more data, but I think the question's important.
You'll get an academic answer.
Well, hopefully you'll get some data. You know.
Right, you'll get some data, but the reality is, you do not know. You did not know that collateralised mortgages were going to catalyse a fall over the Western world, which happened until everybody went, I've got to bail this out, and debt GDP ratios now reflect that as a result of GFC and COVID. And we have no more bullets to use if this happens again. And the odds are we haven't had a cycle, as just said. You've got, if you believe in economics at all, which I think you do, there are cycles every 7 to 10 years typically, and we haven't had one for 15.
So, you want to add something? I'm conscious we've got. We can debate this offline because I'm not here. I want to argue back, but I think I'm meant to be moderating today. I'm happy to take a couple of questions from the audience. There's a lady here in the second row, please. Maybe if you could shout your name out and affiliation. Thanks.
Christine Chow from Carbon Tracker and Planet Tracker. In the spirit of what Deborah says about you win by not losing, my question is on the rise of captive insurance solutions set up by companies themselves. So these are the type of insurance that are possibly being set up by real estate or agricultural companies because they are seeing the risk of not being able to get insurance themselves, so they can create this vehicle to tap directly into the reinsurance markets. How do you see this trend in helping you to better manage risk or providing better information? Is this something that you've been looking at as well? And whilst on the topic of insurance, we're seeing insurance companies are also connecting better between their single-year underwriting business to their sort of the balance sheet side, looking at the longer-term viability of the business. Is there anything left that they can insure? So we're seeing more multi-year insurance contract now coming up, rewarding preventative measures. Is this something you're also looking at as a way of evaluating risk?
Who would like to take that? Tony, do you want to?
I can only comment on one bit, which is the matching assets part around Solvency II, and it's been on the agenda for so long. And if you're insuring something for 10, 20, 30 years, you're getting measured over a period of time which is much shorter. And again, it comes back to that point. That's a mismatch. And I think they need to move on from looking at it to start saying, we're going to invest in the liability matching of private markets can suit well, not just infrastructure, but things like we're in, whether it's energy infrastructure, but also natural capital, which are just hundreds of years. And that sort of liability matching needs to be incorporated into some of the insurance analysis and Solvency II, frankly.
Perfect. There's a question about, and if I encourage you, because we've only got 5 minutes between now us and the mooch, so one question, if possible. Thanks. Gentleman there.
Hello, John Schaefer from Citywire. There's a bit of talk about continuation vehicles and conflicts of interest. Do you think that asset managers should be able to charge performance fees when they create continuation vehicles on unrealised gains?
Who wants to say that? Bayer? No?
Yeah, sure. As relates to continuation vehicles, some level of management fee and some level of go-forward carried interest is the norm. To what degree should that be allowed? It's the crux of the conflict fundamentally, and is a topic that is discussed with an LPAC at the, ahead of a transaction proceeding. There will be an LP vote. There are rights that certainly an LPAC will have to say should this proceed or not. And LPs ultimately can decide whether or not to participate or not if they have a different view on value. But look, there is a conflict there, undoubtedly. Nonetheless, I sit on LPACs, and I see the debate, and invariably there are different views, but generally the view is this is something that we should allow happen. This is something that we should allow because some of the LP base will want that liquidity one way or another. So don't mean to gloss over the conflicts and the governance issues here, but the reality is that LPACs, consistently across North America and Europe are saying, okay, there are challenges to work through, but this is something that we should permit to happen.
But if I can add something, I think the gentleman specifically asked about unrealized gains, right? So
sure, which is, I guess, a somewhat different issue in that, as continuation vehicles are generally, a function of the long-term, more illiquid vehicles, and the topic of carry-on and realised gains has cropped up in the context of the semi-liquid and evergreen vehicles that exist. Should it be allowed? It is a feature of the market. I don't think this is like a point where there's a moral argument either way. There is transparency over what the terms are. Clearly, if you are underwriting a potential investment to one of those vehicles, you want to understand the degree to which someone is buying new assets and crystallizing carry versus buying new assets with a view that they're going to deliver go forward growth potential. Like, which of those two things are being prioritized by that manager? Someone who buys at a discount for carry with no go forward growth potential is not going to have a vehicle that's going to be in existence for any significant length of time.
I'm conscious we're close. Well, Steve, a really quick one. Sorry, have you got
BDCs underperformed the market, what, 30% this year? How worried are you about that? What are the signals it's telling you?
Pascal? Quick answer.
I presume you mean the stock price as opposed to the dividend generation, right? Yeah.
You can buy cheaper in the
Right.
you can off a private credit fund.
Right. It's a feature. And I think this panel is largely representative of people who have been buying cheaper private, right? As opposed to investing in BDCs particularly. You're right. I mean, there has been a long time when BDCs were trading significantly above NAV or price to book, right? Significantly above 1x. That's corrected meaningfully. For the most part, from what I've been able to see, the underlying health of the portfolio hasn't really been put into discussion, and dividend generation, which comes from the underlying borrowers really paying up their interests, has continued to be there, right? The fact that the market's corrected is probably welcome.
Okay. Perfect. Thank you very much. I think we're pretty close to time, so I thought because we a couple of us in the room were at the FT Book of the Year thing last night, I should ask all of you what's been your favourite book this year, which we should all go out and buy for our Christmas presents for our family or people we don't want to. Tony, it has to be a business. What?
I don't read.
Oh, come on. The Gresham House annual report, obviously.
I bought my book 27 years ago. It's still in the suitcase.
All right, Deb.
It's a great question. We were discussing it in the office the other day, actually, and there's loads of a long list of people's recommendations. I think for me, I was just going to say the Psychology of Money by Morgan Housel, and the reason for that is because I think it's accessible for everybody. So kind of for your sister, your auntie, your uncle, your niece, your nephew. It's looking to kind of distill complex financial concepts through storytelling.
Perfect. Pascal.
Nothing written this year.
Okay.
I actually reread for the third time a book that I've read as a grown-up teenager kind of thing, and then when I moved to London 20 years ago, and now this year as a middle-aged man or whatever. The Picture of Dorian Gray.
Okay, perfect. Is there probably that private equity stays young?
That's
those continuation funds, they still look very young to me.
What's happening in the attic now.
Yeah.
I read what I thought was a fun book. It's old now. I think it's written around the time of the financial crisis. It's called The $12 Million Stuffed Shark. It was a book about the contemporary art market, which I knew nothing about at the time, but it's just talking about, it's paying 20, 30, 40, 50 million dollars for things that, are called art. Is it art? It's an interesting debate there.
Perfect. Well, thank you very much for that. My books I put online, so you won't want to see them. Obviously, it should be really the Moochers book, which you've got free in your bags. But before we go to the Mooch, please join me in thanking a wonderful panel.